Nilesh Shah joining in now, founder of Envision Capital. Nilesh, we always enjoy our conversations with you here on NDTV Profit, so thank you so much for coming in. What is the market mood that you're seeing right now? Tariffs was a big concern. We seem to have shrugged that off. World War III, market doesn't seem to care too much. Operation Sindoor, okay, we'll worry for a couple of days. I mean, is this, I don't want to try and sound Gen Z, but is this market delulu or is there something solid going on over here?
No, well, yes, there are some of these speed breakers, hurdles, headwinds along the way. And what we've really seen is all these geopolitical conflicts have been very episodic. They are something which probably lasts for, probably a couple of days, maybe a week. And then after that, basically, there is pretty much peace. So to that extent, I think somewhere the market is beginning to realize that this is something which seems to be very short-lived, though very episodic, but it's still very patchy, very short-lived. And market is taking all of this in its stride. In the process, what's also happening is the collapse of crude. That's something which is probably the biggest positive that's going for India right now. That we have basically crude prices which are significantly lower. That's doing a lot of good to India's macros. We've seen rate cuts happen, liquidity kind of getting unleashed. And all of this is improving micros at the ground level, which I think augurs well for company earnings. So clearly what's happening is that there is increasing uncertainty in the world, but basically all of that is having a rub-off effect in terms of positives for India. And that's something which basically the market is more focused on than some of the geopolitical issues which are become an overhang for some time now.
Okay. Nilesh, good morning. So, are we to say that the risk assets are now squarely looking at earnings trajectory and multiples and discounting these episodic periods simply because there will be noises in the longer term and therefore ignore the short-term noise and focus squarely on the long term?
Absolutely, Neeraj. Clearly, the markets are more focused on the long term. And that's because, firstly, the markets itself have been consolidating since September or October last year. So it's pretty much been a 9-month consolidation that the market has already gone through. It's not that, yes, the markets are now inching towards a high and all of that, but nevertheless, for 9 months, we've been more or less flattish. There have been some sectors or categories or some pockets which have done better and are at a newer highs, but overall, at the index level, we still seem to be essentially where we were 6 or 9 months ago. So to that extent, the markets have already undergone a time-wise correction and a consolidation. So that to that extent, I think is a very, very big positive from purely sheer market levels. Secondly is that the faith of retail investors continues to be unabated. And so to that extent, the allocation to equities has only been increasing. And more importantly, is with falling interest rates on bank deposits, the case for long-term equities becomes even stronger. So third is a move by the foreign investors towards de-dollarization. And clearly, India has been one country where allocations have been underweight the weight in the MSCI. So to that extent, again, you're seeing foreigners starting to come in, but expectation that they could come in a bigger way. And lastly of all, corporate earnings are dealing with a low base. I mean, just to flashback last financial year, we had probably one of the most modest GDP growth. And so to that extent, we are dealing with a very low base. So optically, for June and September quarters, we actually could see earnings, headline earnings, get into the double-digit zone. So these are some of the factors which I think the market is really more focused on than the geopolitical challenges that the world faces.
Actually, Nilesh, that's a pertinent point, right? We were talking to so many people or trying to ask so many people that the first half of, at least for the Indian markets, right? The first half, which is Q1 and Q2 of FY26, will have a really favorable base, right? And therefore, does that incremental growth number look positive enough for the markets to take heart from? Or do people focus on the absolute number and then try and say, hey, maybe growth isn't as good because the advanced tax numbers were not very strong?
Sure. So Neeraj, I probably think that more on a slightly time adjusted basis, but broadly we would have earnings growth of about maybe 10 to 12%,
Okay.
uh, which is not a bad situation to be in, because just in generally from an opportunity cost point of view for investors, it's more like kind of the 6% which bank deposits offer. So if you have corporate earnings at 12%, it pretty much takes care of a couple of years of returns, even if 1 year has been kind of flat types return. So there's a kind of a catch up trade which typically happens with equities. Equities don't behave in pretty much a linear fashion all the time. So there's a bit of catch up which happens. So clearly, kind of going back to saying is that the 9 months have been very flattish. So to that extent, you will see some kind of a catch up trade happen for the next one or two over the next 1 or 2 quarters. And that will also kind of get mirrored through the earnings growth which we will have. So even if I think the headline or the big companies, the large caps, deliver as a group 10 to 12% kind of earnings growth, I think that should at least protect the downside as far as equities go.
Nilesh, what's leading this charge? What's leading this charge in your view and the next leg of this rally? Is it going to be financials? Is it going to be a consumption theme? Is it going to be a capex push theme? Where are you seeing that momentum?
It's going to be all of these factors. Number one, of course, for the financials, especially the large banks, the last few years have not necessarily been very good. They have again they have underperformed as stocks or as a category. So you again seeing a lot of catch up, and then there's some bit of an upside coming in because there's expectation that if foreign investors were to come in a very big way, a lot of that incremental allocation would go into banks because that's the easiest place to deploy whatever millions and billions of dollars. So I think clearly that's one. Two is regarding consumption, we have a situation where there's now lower inflation, leaving more money in the hands of consumers. There's low interest rates, which makes the case for rate sensitives to do relatively better. Third is all of the kind of policy initiatives which have happened, which is increasing the tax exemption limits for India's middle class, number one. Number two, the pay commission, which is expected, the impact of pay commission, which is impacted. All of that, and then some of the benefits coming in from various welfare schemes announced by the state governments. All of that is kind of likely to kind of bunch up in the next few months or the next few quarters. So clearly, I think consumption again stands to gain. Consumption also stands to gain because raw material costs could be lower, which could drive up margins. So I think there's a case for both volume increase, there's a case for margin increase, resulting into stronger earnings. Third is the capex side, and capex including defense, aerospace, EMS, all of those pockets within the overall capex and manufacturing space. That's again a space which is expected to do well because of larger increase spending. Last year, keep in mind, was a relatively tepid year from a spending point of view. A lot of all of that could play a catch up in the current financial year and even beyond. So I believe that it's going to be a combination of all of these, which are going to essentially be driving economic growth as well as earnings growth.
You know, you spoke about defense. I'm wondering how you're feeling about railways, Nilesh, because just in that, taking that forward, railways, road, there was a bit of a pullback in the kind of spends over there in government schemes. Do you see that firing, and do you see the defense rally done and dusted with?
Well, for the very short term, the defense rally, one could basically argue that it's done with because there's been a sharp up move. So to that extent, and yet, yes, there's been the start of order inflows, but it's not yet as much to basically warrant the valuations in the very short term. A lot of stocks are already beginning to trade between 50 to 100 times trailing earnings. So to that extent, and then there's been a sharp up move of between whatever 50% to 100% from the lows that we saw in February, March. So probably in the very short term, it seems to be done. But clearly, if I would think of defense being more a decadal story. I think the whole need to kind of spend on defense and then to kind of back that up with a huge bout of indigenization, which means to procure locally from domestic firms. I think that's basically a very, very long-term growth driver for our defense and aerospace companies. So I would probably think that it's become now, yes, for maybe for the very short term, you could say it's done. But I believe defense is now becoming more a buy on dips kind of a sector. Regarding railways, I would clearly think that defense is likely to take precedence over the railways, because firstly, there's a much wider choice of companies to invest in. In defense, you could probably see, there are whatever dozens of companies, versus that railways, it's a very small handful. And clearly, I think the spending on defense is going to be significantly higher over maybe the next couple of years versus railways. I clearly think between defense and railways, it's going to be more like a snake and ladder. There would be some phase during which defense does well, some phase which railways does well. On the whole, the two put together is a great place to be from a very long-term perspective.
Is that a rally you managed to catch, Nilesh? Because, we speak to people and some, managed to get it in time and some didn't.
Honestly, it's always dil mange more. You never have enough when things go well. And like as George Soros says, when you get it right, you better get it right big time. So honestly, yes, not to the extent one would have wanted.
Okay. Nilesh, the other question is, when Nandan Nilekani says that it is amongst the most challenging times for the business, you stand up and take notice, right? What did you make of what Nandan is saying? What did you make of your own conversations with maybe your portfolio companies or global companies and your readings? I mean, how does Indian IT fare over the next 12, 18, 24 months in such a fast-changing landscape?
So, well, I would tend to agree with, Nandan's views in terms of what he thinks about what's really happening in the global business landscape or the global economic landscape. The global economic landscape stands truly challenged. And somebody like Nandan, who's essentially looked at, the era from the 1990s onwards, where we basically began that era by saying the world is truly flat. Okay, from that now getting into that there is now increasingly deglobalization, countries are behaving in terms of silos. So I probably think his statement is more in the backdrop of that no longer is it now easy to conduct trade on a global basis, number one. Number two is, I think, purely from a technology point of view. And I would probably say that most businesses which are more world facing or global facing, I think I have to kind of deal with lower growth, slower growth, especially in a relative context where the domestic economy seems to be doing a lot better than the global GDP. And two is, we have pockets like capex, infra, defense, railways, domestic consumption, premiumization, all of those as businesses are growing in double digits versus global businesses growing in low single digit. And that creates a headwind for the larger Indian IT companies. I think the larger Indian companies have been growing in single digits for maybe the last decade or so, especially when the world was a lot more benign place, versus that the next decade doesn't seem to be as benign as what the last decade has been. So to that extent, I think for the larger IT companies, they truly have a challenge in terms of sustaining growth. And second is essentially the whole wave of AI, which is coming in, which is driving the world towards more automation and all of those kind of things. And that can make it even more challenging for the bigger IT companies. And therefore, within the world of IT, probably the smaller IT companies, which are more focused, more niche, are becoming specialists in AI implementation. They probably will do a lot better versus their peers, versus their larger peers.
Okay, Nilesh, I'm just wondering, I would like to know your view on this spree of promoter stake sales we're seeing. And it's as if most of them are successful, frankly. The promoters are selling and maybe large investors, mutual funds sitting on the other side. So two-part question. What do you make of this trend? Are you biting at some of those offers out there? And okay, I'm adding a third. What do you say to people who say that these are promoters cashing out when a market is at its peak?
Yes, I think yes, all of that is true, Tamanna, but it's also creating basically supply for the domestic mutual funds. I think they are the guys who essentially have been sitting on a lot of liquidity. They are receiving money through SIPs. The SIP flows still are in the ballpark range of 15 to 20,000 crores. So there's money to be deployed, and clearly, I think if they were to kind of go out there and buy directly into the market, obviously that will create its own. It will create another bubble or so. Versus that, I think when you have these kind of supply coming in from promoters, from the larger private equity funds, or some of the other earlier investors, I actually think it's a nice balancing of demand and supply, which is happening in the market. And so to that extent, I actually think this is very orderly and very, very healthy. Yes, promoters are always the biggest insiders of their businesses and they probably know their business best and therefore the valuations. But I think for many of them, these are first generation entrepreneurs who have essentially come and set up businesses 10, 20, 30 years ago. And they also essentially want to take some money off the table to kind of create security for themselves and their families as well. I think that's really been the most common kind of reason why some of the promoters have been selling. Of course, the underlying reason could partly be valuations, but keep in mind, they're not selling out lock and stock and barrel. If a promoter owns 50% of his company and is going out there and selling it 5%, I still think that's like he's still got more skin in the game versus what relative to what he's selling out. So to that extent, I would probably I would look at more the positives rather than any kind of having any concern that promoters are selling.
Okay. Um, Nilesh, a final word would be the new Reserve Bank of India led tailwinds for NBFCs. You reckon that the next 12 months, it's that one sector to, I mean, there could be many, but it is one of the sectors to ride on because the growth numbers could look strong?
Absolutely, Neeraj. If there's one strong pocket within the entire market and within the entire financial space, I think NBFCs, affordable housing finance companies, and some of the smaller banks, I think this collectively, I think is probably one of the most strongest kind of segments of the market from an outlook point of view. This is the segment which essentially has had to deal with higher interest rates in terms of paying out higher interest rates, in terms of a much weaker liquidity or a poorer liquidity. And so to that extent, they have been facing some headwinds. All the policy initiatives from the Reserve Bank of India over the last few months, I think converts those very headwinds into tailwinds and creates an opportunity for them to grow. Number one. Number two, especially some of the businesses which are more consumer facing, especially areas like affordable housing finance, they will also have the benefit of the tax exemption limits, which have been high, which would make the middle class households eligible for more loans. So to that extent, that creates a bit of an organic growth opportunity for them that if earlier you could give a home loan of say 15 lakhs, you would now be able to give a home loan of 18 lakhs or 20 lakhs. So all of these things essentially, I think, augur extremely well for this pack of housing finance companies, NBFCs, and the smaller banks.
Okay. Nilesh, always a pleasure talking to you. No different today. Thank you so much for taking the time out and speaking with us.
Thank you, Neeraj. Thank you, Taman.